What are you and your team at BNP Paribas most focused on right now?
Well, we had used the analogy for horsemen of the apocalypse is to try, I guess, to illustrate the same point that there seems to be a bit of everything. There's not one thing that the markets are worried about, but if one of those 4 or 6 items that we're concerned about goes a bit better, there's always something else that we can turn to. So I think the key things that we think are going to matter in the near term, certainly the outlook for U.S. interest rates. Is it true? Do we really think the Fed is going to pause next year? Are the dots going to come down and lower rate expectations in the U.S.? That's absolutely crucial. When you look at the market, particularly the U.S. market, and see it as a signal of a growth slowdown, we don't think that's the case, but clearly the markets aren't quite convinced of that yet, so we need to see continued steady data out of the U.S. At the same time, of course, we would like to see the same out of China and out of Europe. Of course, trade wars continue to go back and forth. I think today, frankly, was a bit better with the sign that China is going to remove its retaliatory tariffs on U.S. autos. So I think that's certainly positive. But there's no lack of things to keep us up at night when we really should be thinking about holiday plans.
I guess the headline then would be, Daniel, a lot of little. Maybe a death by 1,000 cuts. But here's the problem with that. And if you agree with your perspective, that's not an easy fix. If we had one big thing, and everybody kind of came together to fix that one big thing, the markets might get, quote, fixed. But the fact that we've got so many other things, so many disparate problems, is that fixable in the near term?
Well, I think it depends at this point. On one hand, certainly market sentiment. Certainly seems to be a market now that reacts most to the negative news. Even if there is good news, you don't see that much of a reaction, or one certainly that's not very sustainable. Maybe it's a day of an up market, and then things seem to reverse. So at this point, given that really the outlook seems to be perceived by the market as so negative, I think you're going to need quite a few good things to really turn market sentiment around and turn the markets around. And I think that's a challenge right now. If you really want to come up, what are some positive catalysts that are really going to excite the market? That's a bit tough. You don't really see much necessarily that's going to go really great in Europe in the short term, similarly in China and in the U.S. So I think the best perhaps that we can hope for is an absence of additional bad news, but really something positive that's going to make people perk up and move back into risk assets. It's a little bit harder to come by.
Well, we got that today. More bad news. Chinese industrial output rising 5.4%. Now, ordinarily, 5.4% sounds pretty good if you're on this side, but for them, that's a slowdown. Retail sales weaker than expected. Just to your point, Daniel, something else that's not good, for lack of a better term.
Yeah. Well, I think with the China data, though, and in this case, actually, bad news may be good news, because we think about the relationship between China and the Trump administration. I think the Trump administration is kind of betting on the fact that China feels a bit vulnerable with their own economic slowdown, which is happening to a degree independent of the trade war. It's much more around their own deleveraging initiatives. So if China is seeing slower growth, to them, that means, well, we want to get out of a trade war. We don't want to have that additional drag, so it makes it more likely that they compromise, which I think is, again, a bit what we've seen today. The other thing to keep in mind is the government is already reacting. And besides the disappointing data that we got in industrial production and retail sales, actually credit growth was higher than expected. It was double what we had in the previous period. So the government is reacting, and that should come through in the numbers, even if not immediately and maybe not quite soon enough for investors.
Okay, obviously, to your point, a lot of stuff out there to be worried about. But listen, Daniel, it's Friday. It's early morning here. Leave us with this. Leave us with an idea. Your team at BNP Paribas, where do you guys find opportunity right now? How do we make money on this chaos?
Well, to be honest, we're tactically overweight equities right now. So we do think the market has overreacted and overweight developed market equities, and particularly in the U.S. It's been the worst performing market. Now, admittedly, that was after being the best performing market through the beginning of October. So it was kind of easy come, easy go. But really, you look at the PMIs, you look at most of the economic data out of the U.S., inflation coming in very much in line or below expectations. So really less worries about, additional hikes from the Fed. If anything, it should be less. So we actually do think there's an opportunity here tactically for developed market equities, and that's where we're looking.
With everything you just said, though, you're still overweight equities.
Well, to be clear, we're neutral. So we say strategically, just tactically now, we think the market has gone a bit too far. So we want to take advantage of that, even if the outlook for next year is certainly much more in line with, we think, average returns as opposed to anything spectacular.
We are supposed to buy low. I mean, somebody said that once, right? I don't know, Graham or Dodd or one of those guys.